Hello, everyone, and welcome to the webinar today. So thrilled to have you with us. We have one of our most frequent speaker here, Rick Gann. He has spoken with us many times about 1031 exchanges, DSTs. We've even gone into, REITs and all kinds of different tax deferral and investment strategies. And we have him back today to go over replacement investments specifically. And so when you do your 1031 exchange, knowing exactly what you should be replacing it with or a strategy to do that, there are actually maybe more options than you think. So we're going to go over that today. And just to tell you a little bit about Rick or Richard Gann, he's the managing partner of 1031 Capital Solutions. He also is an attorney and a licensed real estate broker and a general securities principal. He specializes in all things 1031 exchange, and he's also the co-author of the book, How to Retire from Being a Landlord, which if any of you answered yes, that you do want Rick's book when you registered, Rick will be sending you the book after the webinar. So you can get that in print or ebook version. You can let him know which kind of version you'd like, but he'll be reaching out after this webinar. So it's a great book if you haven't read it already. Really takes this webinar and really goes a lot more in depth into all the aspects of what it means to retire from a landlord. So I highly encourage you to request and read that. Also, we are recording this whole thing and we will be sending you the recording tomorrow around tomorrow afternoon. So keep an eye out for that. You'll also get the PowerPoint slides and one more opportunity to connect with Rick if you did want to reach out to him and ask him any additional questions. So with all that said, we are going to get started. Rick, thank you so much for coming back to talk to our group.
Oh, thank you so much. I appreciate you having me on. Love every opportunity to work with you, Alexandra, and to be able to communicate with all the members of AOA. So thank you for taking time. Again, my name is Rick Gann, and today we are going to touch on some important considerations for folks who are thinking about doing a 1031 exchange in the near future. We are going to include some Q&A time at the end of my presentation, but if my comments today trigger any questions that don't get answered, please jot them down and send me an email after the webinar, or better yet, go to our website and schedule a call to talk with one of our advisors. My email address is rick@1031capitalsolutions.com, and I promise to reply to you in a timely manner. And we will share our contact information again at the end of the presentation. Before we go any further, I am required to tell you that this presentation is not a solicitation. Real estate and real estate securities may not be suitable for all investors. The risks of investing in real estate programs are no less than the risks of direct real estate ownership. Investing in securitized real estate programs typically involves higher fees than traditional investing. The risks of investing in mineral rights are completely different than the typical risks of real estate ownership, including the obvious correlation to energy prices. And although the name of our company is 1031 Capital Solutions, we cannot give tax or legal advice. A little bit about us. I recently relocated from Lake Oswego, Oregon to Seattle, Washington, while my partner, Jason McMurtry, is down in San Diego County. We also have team members who work remotely from Denver and the Palm Springs area. And next month, we'll be announcing a merger with another 1031 specialist firm in the Sacramento area. So we are covering all our bases up and down the West Coast. I'm an attorney by trade, and Jason has an MBA. We've both been working together in this industry together since 1998. I encourage everyone to visit our website, 1031capitalsolutions.com, where we have copious articles, blogs, videos, and educational content. And in a nutshell, our firm exists for the purpose of helping individual property owners retire from being landlords. And as Alexandra mentioned on that note, In May of 2020, we published a book on this very topic, which is available in both print and electronic formats on Amazon. Again, you are welcome to order that book from us directly for free without needing to go to Amazon, and we are happy to send you either a hard copy, which I prefer, or an electronic copy. And again, as I mentioned, if I don't adequately address the subject or you have any follow-up questions, you are welcome to email me or schedule a call on the website. Okay, so let's talk a little bit about the tax burden that we are all trying to manage. The White House has proposed a 2025 budget of $7.3 trillion. To put that in perspective, in 2004, the federal budget was 2.2 trillion. The population has only increased by 16% since 2004, and cumulative inflation over that time is only 66%, which means the proposed budget, adjusted for inflation and population, represents an increase of 72% per person. Do you think the services provided to you by the federal government have increased or improved by 72% since 2004? Probably not. Well, to pay for this bureaucratic behemoth, the White House proposes to do a few things. One is to increase the top income tax rate from 37% to just shy of 40% for folks with an income over 400,000. The White House also proposes to nearly double the top capital gains tax rate from 20% to 39.6%, and to increase the Medicare tax for folks with income over $400,000 to 5%. And so you add all this together, and you've got a new combined top federal capital gains tax of 44.6%. And then, you depending on your tax bracket at the state level, in California, Oregon, I just noticed that says 47%. That should say nearly 57% if you're in the highest tax bracket. That's a numerical typo. And the reason is that if you're in the top income tax bracket in California and Oregon, you can count on a 12 to 13% increase on top of your federal tax. The point there is that you are looking at today, based on the White House proposals, a combined capital gains tax on the sale of improved property of north of 50%. And, for those of you who are thinking about selling rental property next year and just paying the capital gains tax, I'd like to understand what you think you can invest in either the stock or bond market that will earn back the 57% tax you had to pay, especially if the property is older and you have very little cost basis. And that's a rhetorical question, because there is nothing you can invest in that's going to make up for that big of a tax hit anytime in the foreseeable future. Which brings us to the president's proposal to eliminate 1031 exchanges altogether. And this is copied directly from the White House's website fact sheet dated March 11th, 2024. And you can see on the screen that the White House describes 1031 exchanges as a, quote, sweetheart deal that amounts to an indefinite interest-free loan from the government. And frankly, what's so laughable about this statement is that the capital gains tax is arguably the most unfair tax in the entire Internal Revenue Code. And the White House takes the increasingly popular position in Washington that the government is simply entitled to a tax on your gains. Well, first, I should point out that most of what the IRS calls gains is simply a function of inflation. If a property's value increases at 3% per year along with inflation, you really haven't experienced any real gain at all, and yet you are expected to pay over 1/3 or or as much as half of that gain to the state and federal government when you sell the property. Second, the government does not allow taxpayers to offset their losses in a way that is even close to being symmetrical to their gains. Under a fair capital gains tax regime, if that's possible, you would at least have the unlimited ability to offset losses, and capital gains would be adjusted for inflation. Having said all that, we are truly not losing sleep that Congress will pass any law to erode 1031 exchanges, as long as there continues to be the kind of partisan gridlock that we've seen in Washington in recent years. But if you are considering doing a 1031 exchange, sooner may be better than later, despite the fact that we've got now 103 years of like-kind tax-deferred exchanges on the books. You never know what's going to happen. Now, as a quick reminder, doing a 1031 exchange is really the first part of a two-part tax strategy. While you are alive, the idea is to defer the capital gains taxes you would otherwise pay when you sell real estate by replacing your rental property with another property that qualifies as business or investment real estate under Section 1031 of the Internal Revenue Code. There is no limit to the number of times that you can conduct a 1031 exchange, and the vast majority of our clients intend to continue deferring their capital gains taxes until they pass away. This brings us to the second part of the strategy, known as the step up in basis. Under rules that have been around for decades, when you die owning appreciated property, the accounting value known as the cost basis of your property is reset or stepped up to the fair market value of the property on the day that you die. As a result, when your heirs sell that property, they would only pay capital gains tax on the gain, if any, between the sale date and the day that you died. In other words, all the outstanding capital gains that you've deferred over the years is wiped away, and your heirs are only responsible for the tax on the gain between the day that you passed away and the sale date of that property, which oftentimes there's no gain at all or very little gain if your kids are selling a property shortly upon your passing. As you may have heard me say in the past, don't let anyone tell you that this is a tax loophole. Any benefit that requires you to die is not a loophole. Now, I know most of you know these rules, but if you are contemplating an upcoming 1031 exchange, it's important to know the basic requirements. Only rental and business property qualify for a 1031 exchange. This excludes your personal home, it excludes vacation property, and it excludes flip houses. In other words, there are certain types of real estate that do not qualify for a 1031 exchange because they're not business or investment property. There may be other exceptions that apply to those types of properties, particularly your personal residence. But just remember, although all real estate is like kind with all other real estate for 1031 exchange purposes, the property does have to be a business or investment property. You have to use a qualified intermediary when you do a 1031 exchange. Sometimes you'll hear us use the term QI, and then just to confuse things even more, the term exchange accommodator also means qualified intermediary. A role so important they came up with two completely different names for it. And a qualified intermediary, or QI, is simply a non-related third party who must receive your exchange funds excuse me, directly from escrow. If you conduct a 1031 exchange, or at least you intended to, but the funds from the sale of your relinquished property end up going directly to you and not to a QI, you've blown your opportunity for an exchange. You can't unring that bell. You can't unwind that transaction. And nothing breaks my heart more than have a client call me up, describe the 1031 exchange that they thought they were in the middle of. And then I say, oh, by the way, who's your qualified intermediary? And they say, what's that? And then I find out that they received the funds directly from escrow. And I have to be the one to explain to them, unfortunately, this is the end of our discussion. You can no longer do a 1031 exchange. So don't be that person. If you need a QI, we're happy to refer. We have a list of great QIs up and down the West Coast and elsewhere. You need to maintain the ownership structure of your property during your exchange. You cannot dissolve an ownership entity immediately before, during, or immediately after a 1031 exchange. The IRS requires that the same entity be in existence throughout the entire exchange. How far in advance or how far after your 1031 exchange you need to make changes is frustratingly a matter of opinion. And if you ask 10 tax professionals, you'll get 10 different opinions on how soon or how early or how late after an exchange you need to make those changes. But just understand, if you are in a partnership, you can't decide to dissolve that partnership while you're in escrow leading into a 1031 exchange. So keep that in mind. And if you're thinking about dissolving an entity, do it well in advance and talk to your tax professional. As you all know, you've got 45 days to identify your replacement property and 180 days to close on the purchase of your replacement property. Both of those deadlines start on the day you close on the sale of your property. And then when you do identify your replacement properties, there are basically two general rules that limit the number of properties that you can identify for purposes of the exchange. Within that 45-day period, you must either identify 3 properties and then ultimately invest in at least one of those, or you can list more than 3 properties, provided that the total value of those three properties does not exceed 200% of the value of the property you sold. In our case, most of our clients don't even worry about the 45-day rule because we get our clients reinvested in their replacement properties in the first week or two after they've closed on their relinquished property, and we're not worrying about a 45-day identification deadline. Another note, avoid buying replacement properties from related parties. There are all kinds of IRS rules against related party transactions. And most importantly, you must replace the entire value of your relinquished property in a 1031 exchange, meaning you must replace all of the equity in the property. In other words, all of your net proceeds of your 1031 exchange, that all has to be reinvested, but you also have to replace the debt that you paid off in escrow. So when you're talking about how much real estate do I need to buy in an exchange, you have to buy as much real estate as you sold, net of your transactional expenses. And we're going to continue this on the next slide. So when you are looking at your options for replacing your debt, the IRS actually says, you know what, you can pull money out of your pocket to replace that debt, meaning you're allowed to replace debt with equity. But most people don't have, if they just paid off a $500,000 loan on their rental property they sold, they don't have a $500,000 of cash sitting around to replace that loan on their next property. That's why they had a loan in the first place. So setting aside the option of pulling cash out of your pocket to replace the debt that you just paid off, from a practical matter, most people need to get another loan. And when it comes to 1031 exchanges, one of the concerns we hear from clients is their reluctance or even inability to obtain a loan for their replacement property. And I don't blame anyone for not wanting to go through the loan process in today's market. First, investment loans typically come with, today, significantly higher rates than owner-occupier loans. Secondly, lenders have really tightened their underwriting requirements. I just completed a new loan, and I can tell you, I spent more time answering lender questions and providing documents on this recent loan from this last month than all of the dozen loans I've done in my entire life combined. So it's really daunting to just get a loan these days. And then third, the rate on a new loan is almost certainly going to be much higher than the loan that you just paid off or that you are planning to pay off. And so that can be a sticker shock in terms of just the cost of servicing that debt. And for a lot of people right now, selling a property that was cash flowing and then being able to replace that with a cash flowing property can come down to what is the cost of servicing the debt, and that doubling the interest rate may eat up all of the net income that you were hoping to put in your pocket as a result of that replacement property. However, when you invest in a passive 1031 replacement program like a Delaware statutory trust property, you get the benefit of institutional finance rates that are significantly lower than what you or I could negotiate as individual mom and pop investors. And when you invest in a replacement program, you do not have to qualify for the loan that is already built into that investment. You do not have to fill out a loan application. The loan is already in place. And as a result, the bank doesn't know who you are. The only collateral for that loan is the property that the Delaware Statutory Trust already owns. So you are not a party to the loan agreement by investing in that loan. You have no personal recourse liability. You're not involved or responsible for making loan payments. You don't have to sign any documents in front of a notary. There's no public record of you having a loan. So when you pay off the loan on your relinquished rental property and you invest in a passive replacement program that has built-in financing, your debt essentially is wiped away and comes off your credit report, which is going to improve your credit score and might allow you to go do other projects or other things as a result of your balance sheet being cleaned up. So these are all the benefits of being able to replace your debt with debt that's already in place in a Delaware Statutory Trust or other passive replacement program, such that you are really not a party to a loan in the traditional sense, and yet the IRS treats your fractional interest in that underlying loan as though you've replaced the debt for 1031 exchange purposes in the same way that you would if you were to go out and get your own loan. This is arguably one of the most attractive benefits of investing in a passive replacement program, is the ability, without putting pen to paper, of replacing your debt on paper for accounting and tax purposes without actually incurring new personal debt. So let's talk about the most popular form of 1031 investment programs, which is the Delaware Statutory Trust, or 1031 DST. For those of you who are active AAOA members and go on the website and read emails, I'm sure you've seen a lot of talk. Maybe you've heard me talk about DSTs or other folks talk about Delaware Statutory Trusts. But I'm just want to provide a recap, especially for those of you who haven't delved deeply into this topic. A 1031 DST is simply a business trust that qualifies for a 1031 exchange because the IRS disregards the trust for 1031 purposes and allows the investors to be treated as though they are fractional owners of the underlying real estate, again, for tax purposes, even though they're not actually on title for that real estate. The DST, Delaware Statutory Trust, is the only example under IRS rules where you can sell a rental property and then invest in a program where your name is not on title for the property that you are buying, or in this case, the fractional interest in the property that you are buying in a 1031 exchange. In all other examples, your name is on the deed of that property that you bought in a 1031 exchange. That is not the case with the DST. And yet the IRS, going back to rules that are now 20 years old, allows this structure to qualify as replacement property in a 1031 exchange. The most common goals for investors in a 1031 DST program are to defer capital gains taxes, first and foremost, to retire from being a landlord by shifting ownership responsibilities to an institutional real estate operator, if applicable, as I mentioned, to replace the debt on relinquished property with built-in financing, to ultimately avoid taxation altogether by benefiting from a step up in basis. And this, of course, is more of a benefit to your heirs. And while you are alive, to enjoy reliable income from perhaps a portfolio of properties that can be diversified across real estate sectors, across tenant types, and across different geographies. So to recap the typical goals of a 1031 DST investor, our clients are people with significant capital gains looking to transition from being an active to a passive real estate investor who care more about capital preservation and income than they do about get-rich-quick real estate schemes. But let's touch on some of the key attributes of a 1031 DST investment. First of all, you must be an accredited investor. As an accredited investor, what that means under securities laws is that you must have net worth of at least $1 million, not including the value of your home, or as a married couple, you must earn at least $300,000 a year. And virtually everyone who owns rental property on the West Coast automatically qualifies as an accredited investor just based on typical values. So I would assume everyone on this call is an accredited investor, but that's an important just minimum right out of the gate. Also, most of these programs do have a minimum investment of at least $100,000. Some go as high as $500,000, but most are between $100,000 and $250,000. And so if you have $1 million coming out of your rental property, theoretically, you could invest in up to 10 DSTs if you really wanted to go crazy, creating a portfolio of replacement programs. My point there is there's considerable opportunity to diversify in a way that you couldn't do with traditional real estate. The debt on the DST programs that have financing, not all of them do, by the way, some have no debt built in, but for the programs that which is most of them that have built-in financing, they have a fixed debt structure during the life of the program. And with rare exceptions where the DST has acquired or assumed a loan from the seller of the property that they acquired, the typical DST loan is a 10-year loan, and most of those loans have anywhere from a 5 to 10-year interest-only period, and the rate is fixed over the life of the program. DSTs cannot engage in major remodeling or development, and so as I say all the time, this is boring real estate. There's nothing terribly exciting. Nobody gets rich quick investing in DST programs. DSTs are institutional real estate. These are mature, stable properties, and there might be some light, just a little bit of light remodeling, perhaps, but or some touch-up maintenance. But generally speaking, there is very little money in terms of capital expenditures. The reserves are set aside for just traditional maintenance, and your experience as a DST investor is really to buy, hold, get a monthly deposit in your checking account, and otherwise not a whole lot is going to go on that property over the life of your investment. Most DSTs are large multifamily properties. A typical example would be a Class A 350 unit apartment community in a suburb of Jacksonville, Florida, or a suburb of Dallas, Texas, or someplace in the southeast. But we also have quite a bit of industrial, self-storage, triple net retail, senior housing, and student housing. Again, most of our deals are located in the South and the Southeast. Texas and Florida are the two most popular DST states, although we are getting a little less bullish on Florida based on what we're seeing in recent months on increases in insurance costs for properties in Florida. But the demographics you can't argue with. We like the places where people are moving to, not from, where there's solid population growth and job growth, and places where believe it or not, they are landlord friendly and business friendly, if you can imagine. DSTs also allow for full pass-through depreciation in a 1031 exchange. You carry over your cost basis from the property that you sold for depreciation purposes, but to the extent that you invest more money, either through equity or debt in a DST program, or for any replacement property for that matter, you can claim new additional depreciation, again, to the extent that you acquired more real estate than you sold in a 1031 exchange. But you do continue to get your pro rata share of the depreciation. There is no secondary market or redemption programs for a DST. The typical hold for what I call a traditional DST program is 5 to 10 years. The average is about 7 years. And what I mean by that is you invest in a DST, that DST might have one property or multiple properties, but either way, you are invested in that DST portfolio for, on average, 7 years. And in between now and when that property is sold by the DST, you're just along for the ride. You can't call up and ask for $100,000 or $200,000 to be paid back to you. You are invested as a fractional owner in that property, and you're waiting for that property to be sold for your next opportunity to either cash out or do another 1031 exchange. Unless you are doing a pre-REIT DST, which I'm about to talk about as a different 1031 strategy. So the second most popular 1031 investment strategy is to end up owning operating partnership units of a REIT through what's known as a Section 721 transfer. I colloquially call this owning pre-REIT DST properties, but we typically refer to this as a 721 transfer or 721 exchange into what's known as an UPREIT. And the term UPREIT means Umbrella Partnership Real Estate Investment Trust. And it refers to a REIT that is structured under IRS regulations to exchange or transfer ownership interests for real estate without triggering capital gains taxes. The initial primary purpose for investing in a program that ultimately ends up being a REIT investment is the same as our last strategy, to defer capital gains taxes up front. However, unlike the more traditional 1031 DST investment, which could lead to future 1031 exchanges, the 721 transfer strategy only requires one 1031 exchange. So whatever rental property you own now, we're going to do a 1031 exchange with that property, and that's the last 1031 exchange you're ever going to do, going down this path. Investors in the 721 transfer strategy also ultimately achieve greater diversification than a typical DST investment, and they have the opportunity to redeem some or all of their shares from the REIT beginning 12 months after the 721 transfer is complete. That's probably confusing, and the reason is this is a multi-step process. So you are investing at the outset also in a DST under this strategy. The difference is that DST has been pre-slated to be reabsorbed into a REIT. This is a program where the real estate sponsor has a big REIT. They've pulled out a property from their REIT. They've converted it to a DST. They raise capital in that DST. And 2.5 years later, they bring that DST property back into the REIT and they exchange the REIT interests for the DST interests on a tax-free basis. And so you've done a 1031 exchange into a rather temporary DST property or DST portfolio with the goal the entire time of ultimately being a REIT investor, which means now you're invested in hundreds and hundreds of properties rather than 1 to a dozen properties in a DST. And with that comes the opportunity, beginning 1 year after that 721 transfer, if you needed to take money out of the REIT. In other words, to make a redemption request and to have $25,000, $50,000, $100,000 sent to you. Of course, that'll be taxed, but the ability to redeem your interests is quite different than a traditional real estate investment, which of course, your only opportunity to cash out is when you sell the property. And then I should note that even though a DST is a property, an easy property to inherit, a REIT is an even easier type of asset to inherit because your heirs, upon your passing, can call me up, we fill out a form, and they can be cashed out of that REIT in a very short amount of time in a way that you just can't achieve with any other type of post 1031 investment. So let me quickly walk you through the key attributes of how this process works. Again, you're starting off with all the same requirements as a 1031 exchange. You go into a temporary pre-REIT DST property. Then typically 2 to 3 years after that investment, I just say 2.5 on average, the REIT absorbs that property. You transfer your DST shares for REIT shares. And technically, those are called operating partnership units. You continue to receive pass-through depreciation. So the fact that you've converted to the REIT does not alter the tax benefits of investing in real estate and getting to offset your income with depreciation. Typically, you're going to hold those REIT interests indefinitely. These are called perpetual REITs. So the REIT itself isn't going anywhere. And unless you need to redeem shares, in all likelihood, you will be invested in this REIT for the rest of your life. And then upon your passing, your heirs can inherit the REIT interests and then easily redeem those shares, again, with the same step up in basis benefit that we talked about earlier. So all of the capital gains tax that you would have otherwise paid had you not done a 1031 exchange essentially are wiped away, and your heirs are able to cash out your REIT interests without paying any tax, especially if they do it immediately upon your passing. Of course, if you redeem any interest in the REIT before you pass away, that withdrawal, that redemption will trigger taxes on whatever dollar amount you take out of the REIT. So it's really the last place you want to go to access cash if you have available funds from any other source. Okay, now we're going to change to the third and final passive investment program that I want to talk to you about. And this is a truly separate category from, again, the DST program, the DST/REIT strategy, and now we're talking about 1031 mineral rights interests. If you're not from Texas or Oklahoma or maybe Bakersfield, you may not be aware of a separate property interest known as mineral rights. If you buy property in a state with a history of oil or gas production, you'll discover that while you may own the right to build a structure or a home on the surface of that dirt, long ago, someone else acquired the right to extract minerals from under your property. And in fact, there is an entire industry around trading these mineral rights which ultimately generate an income from energy producers known as royalties. Mineral rights are recorded just like grant deeds, and they qualify as like-kind real estate in a 1031 exchange, just like a vacant land or an apartment building or a warehouse. Of course, the economics of and risks of mineral rights are totally different from traditional real estate, because royalty income, of course, is so tied to the supply-demand forces and prices of the energy market. But for those of you interested in doing a 1031 exchange and allocating a portion of your investment into the energy sector, mineral rights could be a suitable strategy for you. Oops. So again, you are starting with a 1031 exchange on the sale of your property. All these strategies were starting with a 1031 exchange. However, a big difference from the first two strategies I referenced, here what you're acquiring are fractional interests in recorded mineral rights with current or future producing wells. And the sponsors who put these programs together basically have what I call a basket of mineral rights, and you are going to invest, say, $500,000 into 127 different recorded fractional mineral rights interests across all these different properties that may be in multiple states, multiple counties, in multiple oil basins. And so you're sort of getting this diversified portfolio of mineral right interests all across the middle of the country. And this allows you to, again, to diversify across multiple regional oil and gas basins. The potential for higher income is significant compared to the boring, good old-fashioned apartment buildings and warehouses and triple net retail properties that we sell on the DST side of things. But again, there's much more fluctuation. As you all know, energy prices are incredibly sensitive to global economics, and it is a completely different risk profile to invest in mineral rights, because the royalties that you're earning from the wells that are on those properties, are all ultimately tied back to the price of oil, which drives the activity that's happening on the properties where you would own these fractional mineral rights. But it does allow you to diversify away from typical real estate operational and economic risks that you can't do unless you get completely out of real estate. So I love the opportunity to, by investing in energy, to have a slice of your portfolio sort of immune from the market forces that are likely to impact the rest of your real estate investments. There's also, unlike DSTs, an opportunity for access to a secondary market for recorded mineral rights. And that does exist. And there are websites of people who trade these mineral rights interests. So theoretically, you could liquidate some portion of your 1031 mineral rights portfolio in a way that you can't do with fractional interest in real estate. You also get the tax benefit of what's known as the 15% depletion allowance, which is kind of a cousin to depreciation, but it's basically an allowance right off the top that gets applied to the income that's generated from your mineral rights. But you no longer are claiming depreciation that you were claiming as a deduction on the rental property you sold, or that you would claim in a DST, because it's a completely different deduction scheme for mineral rights interest than for traditional real estate. And there's no debt on these programs. So I cannot put a client into one of these mineral rights programs if they need to replace debt, or at least I can't use the mineral rights. For some of our clients, they might have a little bit of debt, and we can use a DST program to replace their debt, and then we can allocate a portion of their equity into a mineral rights program. just for a little bit more insight into what these investments look like, with a well-diversified basket of mineral rights, it's possible to experience a sustained stream of royalty income based on how the program sponsor has essentially laddered the type of drilling assets across the portfolio. There are basically four categories of mineral rights assets: PDPs, DUCs or DUCs, permitted wells, and PUDs. On day one, when you've invested in this basket of mineral rights, fractional mineral rights interests across dozens of properties, your immediate source of income from any of those properties is going to be the PDPs, the proven developed producing wells. Those are the wells that are today producing oil or gas and generating royalty interest. Then there are the DUCs, or drilled but uncompleted wells on the property that are in place and they just haven't turned on the spigot, so to speak. And these wells will start generating royalties in the near future. And then finally, the permitted wells and the PUDs represent the long-term potential of the same property to generate future production as the current wells. And so what you've got is this spectrum of future income opportunity, and you've got a mineral rights interest in a very large parcel that is going to have multiple wells drilled on that same property, and you've got income today from one or two wells that are in place, and then income tomorrow from the wells that haven't started producing yet on that same property. And so that's what sort of provides this sustained income stream over the life of your investment. And then 10 years down the road, the sponsor will essentially repackage all of these mineral rights interests, sell them on the market. At that point, it represents a completely different set of producing wells, but you have an opportunity at that point to then essentially resell your mineral rights interests back on the market, and then 1031 exchange into either a new basket of mineral rights, or go into DSTs, or go back into traditional real estate, or catch out and pay the taxes. If you're a green-minded individual like me, you may be less than excited about the prospect of earning income from oil and gas. However, with these mineral rights programs, I can assure you that these wells are going to produce energy whether you invest or not, and someone out there is going to receive the royalties. So why not be you? And with that, Alexandra, I'm happy to take some time to answer some questions if we have time.
Yes, absolutely. Let's do that. Also, I'm going to put up a quick poll for you all. Would you like a complimentary consultation to help you plan a 1031 exchange? And Rick and his team can get back to you and give you a little bit of advice there on what to do. So let's start with some questions. So Eileen asked, what if I don't have any debt associated with my 1031 property?
Yeah, and we do have many clients with no debt, which is great. And so I talk about the debt only because for the people that do have debt, replacing that debt obviously is important and represents potentially an obstacle for them to overcome. But right now, I've got, say, 20 to 25 investment programs on our investment platform, and a quarter of them today have no financing in place, which means if you do not have any debt on your property, you could say to me, Rick, I don't have debt. I'm not interested in investing in a DST that has debt. And so just show me the programs that have no built-in financing, and we can do that. It also gives you the flexibility to invest in the programs that have built-in financing, which would mean that now you would have this prorated amount of debt allocated to you in your investment. But the benefit of doing that is that you would now acquire more real estate in your exchange, and as a result would have a sort of a new level of depreciation that you could deduct to
Mhm.
offset your income. So there are benefits to increasing your leverage, even if you don't have financing on your relinquished property. But as you all know, with debt comes some risk, and because financing amplifies gains, but it also amplifies losses, which is why some conservative investors would just prefer to, to stay in the no debt category. But the short answer to your question is the fact that you have no debt does not limit your ability to invest in the types of programs that we have. And in fact, it gives you the most flexibility because you do not have to worry about debt replacement.
Yeah, it sounds like a great place to be. Heidi has asked several questions. She says, hello, in a reverse 1031 exchange, if a property is bought prior to sale of the rental property, and then if the rental property doesn't sell for a couple years, are there any laws or limitations about how far after purchasing a property before selling the rental in a reverse 1031 exchange?
Yeah, I know just enough about reverse exchanges to be dangerous, just because our clients are typically not investing in a DST program on a reverse exchange basis. But just to review with everybody, the idea behind a reverse exchange is so that people who have found the replacement property that they just have to have can lock down that property in advance without having to sell their property, the existing property first. And the way that works is you set up an arrangement with the same folks that you would use as a qualified intermediary, except instead of paying maybe $1,200, you pay maybe $12,000 because it's a whole
Mm.
different level of liability for the exchange accommodator. And then they take title of that property on your behalf. And so you're parking that property with the exchange accommodator. And then to answer your question, then you're waiting until your property is sold before you then start the 45-day window to and 180-day window to acquire the property that you've got off to the side being held for your benefit. So there's no deadline on how long you're going to take to sell the first property you own, but just keep in mind that you are incurring expenses for that property that you've got parked off to the side, that you've got an exchange accommodator holding title on your behalf, and that those costs are an expense that are going to add to the cost of the whole program. But that's what that is designed for. And as long as you know what those costs are going into it, and then it's worth it because of the opportunity is so great that you can't pass it up, then a reverse exchange can be a great opportunity.
Yeah, I suppose you're buying time in that situation.
That's right.
Okay, Thomas has a question. Is there a set ROI on a DST?
Well, I'll tell you this. No, but depending on the type of property, you can get very specific on the projections, at least from a cash flow perspective. So if it's if we're talking about a Class A apartment community, then there are 10-year projections provided by the sponsor. But as you all know, and most of you own multifamily property in this call, you have no way of knowing 3, 5, 7 years from now what your exact net operating income is going to be on a rental property, let alone a rental property that has 400 tenants. And so history is a good guide for the sponsors who have been doing this for years and know how to project out a reasonable expectation for net operating income. Compare that to investing in a triple net lease retail or industrial property that has a 20-year loan. Yeah, to the penny what your income is going to be because that is predetermined contractually under the lease. But part of ROI, of course, is what is the ultimate sale price of that property down the road. And that's a function of really what is the cap rate going to be for that property type 7 to 10 years from now. And that's the crystal ball, factor. And we can do modeling where I can say to you, hey, based on this range of potential, what we call exit cap rates, here's what your range of ROIs could be. We do this all the time. But again, we have no idea what the cap rate is going to be on any given property in the future. So all we can do is do a sensitivity analysis to try to give you a range of possible ROIs on any given property.
Hmm. Okay. Cheryl asking, how do you find uprates?
Well, you don't have to find them. They're out. There's a relatively small group of companies today that have these programs. So if you look at all the REITs that are out there in the United States, really relatively few of them have established these DST/REIT programs that allow you to 1031 exchange into a pre-REIT property and then transfer into the REIT. But of the ones that are out there that are institutional, that have a track record doing this, there's a half dozen of those that we work with day in and day out, and they are all big, multi-billion-dollar institutional companies, and some of the REITs that we work with have $3 to $6 billion of assets with tens or hundreds of thousands of investors. I mean, these are big REITs and institutionally operated. And so if you are interested in learning more, then reach out to me and I could walk you through, who these half dozen REITs are. And at any given time, we typically have a program available for each of those different REIT sponsors.
Yeah, and I think related to that, Heidi had asked, could a REIT cash out? What are the risks of a REIT? Well, we'll go with that one. She has other questions too, but I think different topics. So
that's a great question,
yeah.
actually, because the firms that we deal with, all of them are, by the way, are public companies, meaning that they are public registered SEC. They have boards of directors. They have to do all of the Sarbanes-Oxley and 10Qs and 10Ks and all the different things that any public company has to do, and all of the corporate governance. And they all exist on what's called a perpetual basis. And meaning that just like, for lack of a better example, a mutual fund that you invest in through one of the big financial institutions whose name when you invest in that mutual fund, there's no intent today by the company, by the managers, by the investors, that fund is going to just fold up and cash out one day. It's essentially a perpetual fund. And some of the mutual funds that I'm personally invested in, I assume that they'll be around for 50 years, 100 years, and they'll just keep going. And so these REITs, when you look at their registration statements, they register with the SEC as a perpetual entity, meaning that the intent is that this entity is just going to live on, as the name suggests, perpetually, and there's not going to be some cash out moment the way that some REITs operate, where they tell you up front, we're going to raise a bunch of capital, we're going to invest in a bunch of assets, and then our plan is to then liquidate these assets and cash everybody out. That's not how a perpetual REIT works. They establish this portfolio, they've got billions of dollars in assets, and then they set aside 20% of the value of the REIT in liquid investments, cash money markets, so that each year up to 5% of the value of the REIT can be redeemed by investors to cash out, and just like a mutual fund does.
Okay, great explanation and clarification there. I also have here Sheena asking, where can I get a listing of QIs on the East Coast?
There's an organization called the Federation of Exchange Accommodators, and not all QIs are members of that organization, but that's a great place to start. Federation of Exchange Accommodators. And honestly, your best source really is to talk to your real estate agent, talk to your escrow company, get a personal referral to a QI. But if none of the other tax or real estate professionals that you're working with have a confident referral for you, then I would suggest going to the FEA, Federation of Exchange Accommodators website. They have a list on there of all their members in all the states, and that's probably your next best bet.
Okay, great. Different Thomas asked, can you swing out of 1031 DST non-landlord back to a landlord?
Yes. Yeah. And that's, by the way, if I didn't say this earlier, one of the key differentiators when I'm presenting these options to a client for the folks who decide that they want to stick with the more conventional DST and not go into the REIT option is because they've expressed to me, hey, Rick, my intent is to stay down this DST path for the rest of my life. But, if an opportunity comes, 6, 7 years from now, some real estate opportunity, I don't want to give up the ability to go back into a traditional rental property situation. And even though I'm stepping away from being a landlord, something might come down the road through family or through friends or through my partners or whatever. And, I don't want to lose the ability to do that. Well, then the traditional DST is the way to go, because if you go in the REIT strategy, once you go into the REIT, you cannot exchange out. But in a DST, like I said, on average 7 years, you are presented with a new opportunity to do a 1031 exchange, and you can go back into traditional real estate. You can go into a DST, you can go into a pre-REIT property, or you can cash out. You have all the same options that you have today.
That's great to have that option. Dee had a question here. She says she just got an offer on her rental property today and she has no debt on it. So she's wondering if she says, can I deduct all expenses of sale, such as loss of income rental and repair expenses, or is the sale price the number to deal with for taxes?
Good question. The typical expenses that the IRS has articulated as, what ultimately represents the net sale price of your property for purposes of replacing value is you start with the sale price, obviously, and you are allowed to deduct any of the traditional expenses of a sale, meaning the real estate commissions obviously is the largest cost, but any of the title and escrow charges. Now, sometimes what you'll have built into your escrow are expenses that are really operational expenses of your property that you are agreeing with your buyer to sort of build into the escrow. Those cannot be deducted as so you need to replace those values. However, you can still deduct them as an operating expense of the property. So it's a matter of which are you going to deduct from your 1031 net price or from your income. Either way, you're going to get that deduction. But just think of it as what are the true transactional costs of selling a property? Those are the expenses that you're allowed to reduce your sales price by for purposes of replacing that value in a 1031 exchange. And if you go by that rule, that may require you to add a few dollars to your exchange, or you could forego that, know that you're going to have a little bit of taxable boot is the term we use in your exchange, but then you're going to be able to offset that boot by deducting those same expenses as an operational expense. But you want to talk to your tax professional if you've got anything odd in your escrow that you might have a question about. Also, a good QI is a great resource because they're highly skilled in identifying these types of issues. And of course, you're welcome to reach out to me, and I can give you my 2 cents. Again, I cannot give tax or legal advice, but I'm happy to sort of point you in the right direction on what we've seen as sort of the typical expenses that you can or can't deduct as part of your 1031 exchange value.
Right. Yeah. And then she also had a question about how long she can get income from the DST. Is any income guaranteed? She says, I'm happy with lasting income versus re-engaging in another rental landlady situation and has no heirs.
Right. Well, you just described, a lot of people, and if you don't have heirs and you're less motivated by, the ease of inheritance, then then that typically means that maybe you're not as compelled to do the REIT strategy as the more traditional DST strategy. But I will tell you that we do have a bit of a spectrum. Like I said, you can be on one end where you've got self-storage, multifamily, student housing, all these sectors, or even the most extreme, hotels, where the net operating income is changing on a daily basis, all the way to the other end of the extreme, where it's a portfolio of long-term leases with fixed rental amounts, where I can project for you what your income is going to be, barring some crazy situation with a tenant leaving, and be able to tell you this is what your income is going to be to the penny over an extended period of time based on what's in the DST. And sometimes the ones that have the more secure income have less opportunity for upside, right? Because if the net operating income is not going to go up over time, the value of that property may not have as much upside potential. But some of our clients really are focused on, I'm willing to sacrifice a little upside potential for knowing exactly how much money is going to go into my checking account every month. And this is the art of what I do every day, is trying to strike that balance and find out what's most important to you. And sometimes it's diversifying across these different sectors, and sometimes it's, hey, we're just going to focus on income. And so that's a long-winded way of saying, yes, we can achieve the goal that you mentioned. You're in good company, and we have enough of a menu to give you some diversification and still really emphasize that reliable income.
Yes, that is the beauty really of having the options that you have available for your clients. Stella was here asking, she says, we had an owner carry balloon and sell in January. Is it too late to reinvest the sale in a 1031 exchange? We have a property we'd like to buy and are hopeful that it will count.
Yeah, this is a long it'd be a long answer. And I would probably need a little bit more detail, but
Hmm.
most of the time, if you sold the property and you held back a note, at that point it's too late to do an exchange. You can hold a note and do an exchange, but you have to, analogous to the way a reverse exchange works, you actually have to have that note held by a qualified intermediary. And if you just did a traditional deal where you sold the property and you held back a note with a deed of trust on that property, it's now, unfortunately, it's too late to parlay the value of that note into into a into an exchange. When that balloon payment is paid. So anyhow, but I'm happy to point you to some resources to get some clarification on that. But yeah, I unfortunately I think it's already too late based on what Alexander's described.
Yeah, well, we'll see. Stella, we'll have someone reach out to you. And Sheena stated, this has been a very informative. Thank you both. So I think we'll end on that positive comment.
Sure.
And so, as I mentioned before, I'll be sending the recording and the slides to everyone tomorrow. And if you did have a question that was not answered for some reason, if we missed it for whatever reason, Rick always gets back to you. And he'll also be sending out the book. If you did request it when you registered, please take the exit survey on your way out. It would really help me out a lot to get your thoughts on just a few little things there at the end. And I hope you all have a wonderful day and you join me for our next webinar. I'll be presenting next week all about HUD's new guidelines on criminal background checks. We'll also be talking about evictions as well. So that will be in the follow-up email too if you want to register for it. And Rick, thank you again. You're always bringing something new. I swear, I always think I know almost everything about what's 1031s because I've heard so many presentations, but I still learned a few things today myself.
Well, good.
And I think everyone on the call definitely did too. So really appreciate you.
Thank you. And I appreciate you. Thanks, everybody. And feel free, again, go on the website. We have so many resources. Take advantage of all that and schedule a call. I'd love to speak with everybody on this call.
All right, everyone. Have a great day. Take care. Bye.